Good day, my name is Ming, Head of Fixed Income Strategy at RHB Bank, Group Treasury and Global Markets. Welcome to our Fixed Income Market Outlook podcast again. For today's podcast, we will be sharing updates from the recent June FOMC meeting, changes to the Fed dot plot projections, and our expectations for global interest rates environment to remain lower for longer given the need to support growth prospects. We hope you will find this podcast useful. In the recent June FOMC meeting, US policymakers resonated a weaker outlook on the US economy. The US Fed revised lower its growth forecast for the US economy to contract negative 6.5% in 2020 compared to previous level in December 2019 with expectations of 2% growth. In terms of US labor market, unemployment rate is expected to remain elevated in 2020 due to weaker macro conditions and impact from COVID-19 pandemic, with a projected level of 9.3% versus its forecast of 3.5% back in December last year. Inflation, meanwhile, is expected to remain low, below the Fed's inflation target level of 2%. Hence, we view the improved US May non-farm payroll data may be transitory as the overall trend for US unemployment is expected to remain elevated given the challenging macro backdrop. Recap: US job data improved in May, which resulted in unemployment recovering to 13.3% versus April's 14.7%. In the latest US dot plot projections released in June, US policymakers expect the US key policy rate to remain near zero till 2022. This reiterates the Fed's continued dovishness in its monetary policy decision. The US Fed maintains its pledge for unlimited bond buying activities. The US Fed will continue to purchase at least US Treasuries $80 billion per month and US mortgage-backed securities at $40 billion per month. We believe this will keep US Treasury yields supported. At the concluded FOMC meeting, US policymakers commented that discussion on yield curve control strategy remains ongoing at future FOMC meetings. In its latest strategy, the US Fed echoed that it will begin buying individual corporate bonds under its secondary market corporate credit facility, an emergency lending program that to date has purchased only exchange-traded funds. We expect this to help improve investor confidence and help calm US credit markets. The secondary market corporate credit facility is one of the 9 emergency lending programs announced by the Fed since mid-March, aimed at limiting the damage to the US economy by the COVID-19 outbreak. With a capacity of $250 billion, it has so far purchased about $5.5 billion in ETFs that purchase corporate bonds. In addition to monetary policy easing measures and bond buying activities, some central banks have embarked on yield curve control. The Bank of Japan implemented yield curve control by maintaining the yield levels of 10-year Japanese government bonds at 0%. In Australia, the Reserve Bank of Australia also implemented yield curve control, keeping the level of 3-year Australian government bonds at a yield of 0.25%, which is parity to its key policy rate of 0.25%. Given the need to support growth and complement fiscal support, we expect the outlook on monetary policy to remain dovish in the coming months. Here is a snapshot of key policy rates changes of major central banks in 2019 and year-to-date 2020. Bank Indonesia recently cut its policy rates by another 25 basis points to 4.25% amid rising downside risk to growth. It also signaled that it has room to cut policy rates further and is prepared to do more quantitative easing via direct purchase of government bonds. Back home, the combined year-to-date 100 basis point OPR cut by Bank Negara has boded well for the domestic bond market, with bond yields staying supported. Bank Negara's next 2-day monetary policy meeting is scheduled on 6 and 7 July. The central bank's assessment on growth and stance on monetary policy direction remains a key focus for investors. Ringgit government bond yields have significantly tightened thanks to recent OPR cuts and inclusion of MGS and GRI as eligible assets for SRR computation. For instance, the current 3-year and 10-year benchmark MGS have both tightened by circa 70 basis point and 40 basis point respectively compared to end December levels. On balance, renewed positive vibes have emerged for ringgit bonds. For the month of May, foreign holdings of ringgit government bonds returned to positive with net inflow of ringgit 1.4 billion. Foreign holdings of ringgit government bonds improved from 21% in April to 21.2% in May due to increased holdings of MGS by ringgit 1.9 billion. Given that policy rates in developed markets will remain at ultra-low levels, the hunt for higher yields is expected to persist, which will bode well for Asian local currency bonds and ringgit bonds. In summary, we remain positive and continue to have a constructive outlook on the ringgit bond space given the global theme for yield hunting in the medium term. We hope this episode of our podcast has been useful. Thank you, and please continue to stay tuned to our upcoming podcast series in the coming months as we continue to share more updates in the fixed income space.